everybody, welcome to the studio. Today we will discuss about a book, the book called One Up on Wall Street, written by Peter Lynch. This book already sold more than 1 million books since published in 1989. This is one of the New York bestsellers book. Okay, this book gives us a lot of things, a lot of tricks, how to invest for today. In the studio, we already invite 4 young investors, which is Andy. Thank you very much for spending time during this weekend to discuss this book. Ibu Fitri, welcome to the studio. Thank you very much. During the weekend times, you want to spare the time to discuss this, which is very valuable for our audience. Okay, next, this is the young investor. Everybody knows already, right? This is Adit. Adit, welcome to the studio. And the last, this is the guy, the handsome ones. Freddy, thank you very much for coming to discuss this book to the studio. Freddy, as a young investor, what kind of the things that you need to prepare before to do some investment in the stock market, according to Peter Lynch?
Well, according to Peter Lynch, however, some principles are need to be well understood before we buy our first stocks. The first one is pick the right stocks. Okay. By picking the right stocks at the right time, at the right price, the market will take care of itself. Of course, it is not in terms of a short term. Fundamentally, we need to calculate those companies that are undervalued or underappreciated at the right time. Remember, invest in companies, not in the stock market. Ignore the short-term fluctuations. The second one is invest in a house before you invest in the stock market. It's very clear and it's interesting since house is still a very good investment that everyone managed to make. Millions of real estate amateurs have invested brilliantly in their houses. And of course, house is not like stocks. The risk is lower. The next one, the question is that, am I a short or long-term investor? Do I need the money? Large profits or large losses can be made in common stocks. Even buying the blue chip stocks would be too risky to consider. Blue chip still can fall down and stay down for over a 3 years period or even 5-year period. That's why only invest what you could afford to lose without that loss having any effect on your daily life. The next one is, do I have the personal qualities? This is the most important question of all. It seems the list of qualities ought to be included, such as patience, common sense, a tolerance for pain, open-minded, persistence, humility, a willingness to do independent research, as well as an equal willingness to admit the mistakes, and the ability to ignore panic situations. It's also important to be able to make decisions without complete or perfect information.
Thank you, Mr. Freddy. It looks like the investment is like an art. Is it investment art or science?
I think this is related to the next number, which is do not overestimate the skill and the wisdom of professionals. Take advantage of what you already knew. According to Lynch, investing in stocks is an art, not a science.
Wow.
And people who have been trained to rigidly quantify everything have a big disadvantage. If stock picking would be quantified, you could just rent the time on computer and make a fortune. But it doesn't work like that way.
Since the investment is an art, more than an art, than the science, so it's a little bit difficult if there is no guidance how to pick the good stock or the company, since you tell us that investments is for company. Any one of you can tell us how to pick a good stock and how to pick the good company. Maybe Adit, can you tell us? And then what Peter said on it, please.
Okay, thank you, Paul. To pick the good stock, we have to be able to know the nature of the company itself. Peter Lynch defined the company category into 6. First is fast grower. This is the small, aggressive company who have the potential to grow around 20 to 25% a year.
20-25% a year?
Yes,
Okay.
it's very good. And normally, this is a company that has a unique and innovative product, like
Okay.
Apple, Twitter, or Facebook.
Okay.
Yeah. And also, we can pick the company that just expanding and duplicating their success business.
Like JW Marriott?
Yes,
Okay.
correct.
Okay.
It was able to grow 20% by capturing a larger market segment.
Yeah.
Even though at that time, the growth of the hotel business is only 2%.
Yeah, yeah,
Okay.
yeah.
The second is slow grower. Well, this is not so good. This is the large and aging company that are expected to grow slightly faster than the gross national product.
So above national product?
Yes, above, but slightly.
Slightly above. Okay,
Yes.
okay. So that's the type of company that we can pick.
We have more, but
Okay, please.
the other is Stalwarts. This is also a big company like Coca-Cola, P&G, Telkom, normally listed as a blue chip company, which is still have a room to grow. They are not exactly agile climber, but still faster than slow growers, and they offer pretty good protection during recession. This is the most important.
Okay.
Okay. The fourth is Cyclicals. This is a company whose sales and profit rise and falls with economy. Example like autos, airlines, and steel industry. Next is the fifth is turnarounds. This is the company that this is a fallen company which turn around and become successful. The best thing about investing in successful turnaround is their turn up and downs are least related to the general market.
Okay. Okay.
Yeah. The last is asset plays. This is the companies that have valuable assets such as land, like a hotel or real estates, which the asset price will be double or triple in the future.
So we talk about asset here.
Yes.
Okay.
We
Okay.
focus on the asset.
Asset.
itself.
Okay.
So to get the maximum returns, you may focus on the fast grower, asset plays, and turnarounds. However, the Starwatt is also good for long-term investments and stock diversifications. Why? Because it will protect your assets during the recessions.
So from the six type of stock, is we choose four.
Yes.
One is for diversifications.
Yes. That's
Okay.
correct. For your protection of your portfolio.
Okay. Then next.
That's all, Pak.
Oh, that's all. Thank you very much, Mr. Adit.
Okay.
Any one of you can tell us how to minimize risk and how to increase the profit. Okay, Fitri, please. Thank you very much. Please.
Peter Lynch said that to maximize gain and also to minimize risk, it's best to own as many stocks as possible. But in small portfolios, Peter Lynch recommends to own between 3 and 10 stocks. Why? Because there are several possible benefits.
What is the benefit?
Yeah. First, the more stocks you own, the more likely that one of them will become a 10 bagger. And the second, the more stocks you own, the more flexibility you have to rotate between the stock.
So we spread the risk then?
Yes,
Okay.
of course. That's why another way to minimize the risk is by spreading the money among several categories of stock. But of course, after we do all the proper research and make sure that the companies are not underpriced.
So do you mean the 6 type of the stock and then we pick off 4 of type of them?
Yeah.
Okay. Then?
Peter Lynch also said that it's worth to consider the characteristic of the company. Slow growers are low risk and low gain, but stalwarts are low risk and moderate gain. Asset plays are low risk and high gain, whether the cyclicals are either low risk, high gain, or high risk, low gain.
So this is related to what I
Yes.
did explain before.
Yes, of
Okay,
course.
then wow, this is getting interesting.
Yes, and there are two more company characteristics. The fast grower and also the turnaround
Okay.
is almost the same characteristic. there are high risk and also high gain.
Okay. Thank you, Fitri. When is the best time to buy then? If we know all of this to minimize the risk and to increase the gains.
Actually, no one can predict the market.
No one can predict the
Yes,
market.
of course.
Even though we can do our self-analysis like Freddy said before.
Yes, of course.
Okay, then?
But there are some signs which is worth to consider on when to buy and when to sell a stock. Peter Lynch said that there are two particular periods when great gains probably happen. First is during the end of the year, which is between October and December. And the second one is during the collapse, drops, and free falls that occur in the stock market every few years.
So this month, November, is the good time to buy then?
Yes,
Wow.
according to Peter Lynch.
According to Peter Lynch, okay. Okay, now our discussion getting hot, not getting interesting anymore. So we talk about stock already. We know how to identify the good stock. We know how to identify good company. My next question is, does Peter Lynch touch a little bit about how you call it future or options? Does he touch it? Any one of you can explain it?
Okay, according to Peter Lynch in the book, the future option had a little bit different with the stocks.
What is the difference?
Because future and options are able to do the activity without having the stocks itself. Okay.
Okay.
Usually, future and options have creating a mutual agreement between the sellers and the buyer in some period of time to get some benefit with them until the expiry date of the agreement itself. It can cover the risk of the price volatility for the sellers and the buyer, transferring the risk to the investor, and then means the investor will having the risk, and whether it is loss or it is benefit, and the investor will get the benefit or the loss itself.
So, on this case, in the future products, so the risk will be covered by the investor.
Yes.
Okay. Okay. My next questions: does Peter recommend for investor to buy the future or options?
No, never. Peter Lynch never recommended for the investor to buy an options of the future.
Any specific reason on it? Why?
Yes, because according to Peter, the program required them to automatically sell the stocks directly when they buy the stocks. So when at the same time when they're buying the stock, they have also to sell the stock at the same time.
At the same time?
At the same time.
So
the impact is when the automatic massive selling drove the market lower, triggering more buying of the future and more selling.
Okay.
Therefore, he's never suggested for the investor to buy future or option.
Oh, thank you, thank you. This is very good information for us. Oh, Peter, he's a clever one. I know. We already discussed a lot of things about this book. And then it is getting interesting. I do believe that this book will be very useful for us. Okay, I need to know, as a young investor, do you think this book is very useful for you? And do you think all the things that explain in this book is applicable to Indonesia market now on? Maybe Mr. Freddy, you can tell about this. What is your response on my questions?
Which one do you like, Pak?
Is this book
first one, positive one or negative ones?
Both.
Both?
Either this is good for you or this is negative. Or
okay, we start from positive ones, okay?
Okay.
Basically, this book is very good for the first entering investor because it is able to describe the concept and process of the stock's investment.
Yeah,
Earlier.
we already discussed it.
The book also covers some important basic aspects of fundamental analysis and tips to cover a potential company.
Okay, yes, the 6th company that we discussed
That's
before.
right.
Okay.
Yeah. And next, the negative ones.
Yeah.
Okay. And the negative ones, the first one is that the maturity of the U.S. market compared to Indonesia market is different.
Yes, totally different because they have this kind of markets longer than ours.
Yes, right. The second one is that the book is good in theory, but no longer relevant to the hyper-speed market today.
Oh, really?
Yeah. This is the most important notes that we have to take.
Wow, thank you for the note, Mr. Freddy. Okay, my next question, and then this is my last questions. before we close these discussions, very interesting discussions. During the break, this question actually especially for Adit. During the break, you tell us that you follow the guidance from this book, which is wrote by Peter Lynch in day-to-day investment that you did. What kind of the lesson learned that you can pick from this book? Could you please to share it with us?
Okay, but based on the books, and right now I implement also in the stocks. I can share the lesson learned that I get from this book. To invest in stock, we have to understand the nature of the company.
Yes, the stick company.
Yes, we described before.
Yeah.
Okay. The second is, it is preferable to invest in the company that we have known best, based on our knowledge and research, of course.
Yeah.
It is good to pick the stock from the list, for example, LQ45, Compass 100, or Business 27.
So it's good to pick up the stock from it. Okay.
But it will be better
Okay.
if we know the fundamental of this company itself.
Okay. Okay. Anything else?
Yeah, and the third is don't invest your money in the stock that you will use for the next 3 years.
3 years?
Yeah.
Okay.
Try to allocate the investment for long-term periods to maximize your profit.
Okay. Can you repeat the last one? That's very interesting.
Okay. Don't invest your money in the stock that you will use for the next 3 years.
Don't invest your money that you will use in 3 years.
Yes.
So should be the idle money during 3 years.
More than 3
More
years.
than, okay. Then okay, that's
You
good.
have, if you have money that you need to spend below 3 years, better not to put it in stock.
Okay, that's good tip. Okay.
Yeah. Because to maximize the profit, you need to invest in the long-term periods.
Anything else that you want to share with us?
Uh,
Without the period of 3 years, more than 3 years. Any other things?
okay, I have another one is always do research before you invest your money. Investing without research is like playing a poker without looking at the cards. You can imagine, you just pick up. You don't know which one you choose.
Yes, you're right. This is not a gambler player. This is not a gambler player. Okay.
Yeah, that's, I think.
Thank you very much, Adit. Okay, audience, now this is the time to end our discussions. All the young investors already explained and shared what is the content of this book. So I do believe all of us ready to invest. So remember, investment is an art. Do believe, pick the good stock and pick the good company. Happy investment. Thank you very much. See you for next program.